Hello everyone, very good evening to all. Welcome you all in the session of Oliveboard. My name is Saloni Gupta, and yes, today we are again with a very new unit, that is unit number 9 of module B. So we have started our YouTube series where we have completed our module A, every unit, the all important concepts. We have started module B and we have completed Unit 7, Unit 8. Two units we have completed. And those who have not watched those units, I highly request them to go and watch. All the important things are being covered in all these particular sessions. Today we have to start unit number 9, and the name of the unit is Capital Investment Decisions. So I hope everything is fine. My audibility, my visibility, please confirm me once so that we can start our today's session. So yes, what is capital budgeting? Sorry, what is capital investment? See, you need capital for your business. You need capital for expanding your business. You need capital for making different investments on different projects. You need capital for purchasing any company, for acquiring any company, for mergers, for acquisition. So you need capital for everything in your business. So capital investment means suppose you have to invest on different projects. So for every project you need capital. Now you have a limited number of capital as well. So how you will going to decide which project is good for you, which project is bad for you, so that you can make a proper investment. That is what we do, different decisions on that. We use different techniques. We use different models to come to the conclusion that yes, this particular project is good for me, or this particular project is not good for me. I can reject this project. So we have different decision criteria, and on the basis of such criteria, we take decisions related to capital investment. Now, the goal of management is what? It is to increase the wealth of the shareholders. Again, increasing profit is another criteria, but increasing the wealth of the shareholders, it is also very crucial for any business organization, because any business organization is known by its shareholders, by their shareholders. If the shareholders' wealth are good, if they have a good reputation in the market, if their market price per share is good, increasing, then definitely they have a good wealth. So we have to increase the wealth of our shareholders as we increase the profit of our company. So financial manager has to analyze every aspect, every possibilities, you can say investment possibilities, to identify that this is good, this is bad, so that they can boost up the company. So we need to identify all the opportunities, the market, whatever market needs, what is the desire of the market, how much is the growth potential for in our business. So accordingly, that studying every phenomena, we identify different opportunities where we can invest, where we cannot invest. We have to evaluate certain projects also. In the coming slide, you will see that you have different techniques. You have different uh, traditional and modern methods which you can apply on your project to know good or bad. Cost benefit analysis. It helps in comparing the expected cost against potential benefit. Whatever returns you are getting and what cost you have made in that particular project, it will help you to analyze the cost benefit. Means the cost should be less and benefit should be more, then only you can accept this project. Net present value. Net present value, it basically tells the present value of all the future cash flows. Suppose you have 100 rupees. So is the value of this 100 rupees be same after 5 years? No, it would not be same. It would be different. Clear? So what is the time value of money? So this is called what? Time value of money. What is the value of your money, the which you have today? What will be the value of that money in the future? So we calculate what? We calculate the present value of all the cash, of all the future cash flows. Then internal rate of return. If you will study all these things, IRR, you will see that internal rate of return is what? The rate of return which you are getting when investing on any kind of project. So it basically tells that where your NPV is zero, that is net present value, when it comes to zero, that is the position where you are getting your IRR. Payback period is what? It tells you that lower the better. The criteria for this is lower the better. You have invested 1 lakh rupees in 2020. Now, how much time it will take to recover your initial cost? That is the payback period. The least the time it will take, the good the payback is. That is lower the better. If you will get this 1 lakh rupees on 2024, means after 4 years. And if you are getting this 1 lakh rupees in 2022, after 2 years. So which one is good for you? Again, the second one is good for you. Why? Because it means uh, the soon you are getting your money back, that is the best, that is the comparatively better criteria for payback period. That is why the decision criteria for this is what? Lower the better. As soon as you recover your invested amount, that would be more good. Then financing the investment, how much you have cash in your hand, okay, how much you will take the help of debt, how much you will take the help of equity, how much you will take the help of your internal accruals. So that is financing the investment. Third is risk assessment. Yes, whenever we take any kind of project, we invest, we need to assess all the risk related to that project. How much risky that project is, what are the things that are required to minimize the risk. So, potential risk associated with the project, you need to assess that. Then, at last, you need to monitor and evaluation that the performance of the company. So, this is what this is cash inflow after tax. So, for every project, you need to calculate either CFAT or you need to calculate either PAT. Here, see, if you will see this, we have two types of capital budget techniques. The one is traditional, the next is modern. In traditional, we have two: payback period and accounting rate of return, whereas in modern, we have four. Except this ARR, this follows which kind of cash flow? CFAT. All this follows the cash flow CFAT, that is cash flow after tax. Whereas the average rate of return, this is the only method which follows the cash flows, that is PAT, profit after tax. And what is one thing that differentiates from CFAT and PAT? That is that one element is depreciation. Clear? Now, if you need to find the CFAT, so how you will going to find? We have seen in our income statement that if you will deduct variable cost, you will contribution will be there. Then deduct fixed cost, what is coming? Then EBT, that is earning before tax. But it is being assumed that in this earning before tax, the fixed cost and depreciation has already been deducted. After that, we will deduct tax to get earnings after tax, or you can say profit after tax. And this is the tax and this is the profit which AR follows. But if PAT is given, and we have to calculate like NPV, we have to calculate IRR method, we have to calculate profitability index. What kind of cash flow we need for this cash flow after tax? Because just now we have studied that all of these methods will consider CFAT except ARR. So what you have to do in this case, if PAT is given to you, simply add depreciation. If you will add depreciation, we have deducted depreciation over here, and we will again add the depreciation. Why? Because this is non-cash item. This will not going to affect the economic condition of the financial condition of the company, because it is your non-cash item. It is you are using the machines and the value which you have depreciated, that is a non-cash item that cannot be measured in terms of cash. So again, add depreciation to get your answer CFAT, that is cash inflow after tax. If CFAT is given and you have to find ARR method, what you will do? Simply you will deduct the depreciation. You will get from PAT to CFAT, simply add depreciation, and from CFAT to PAT, simply deduct depreciation to get PAT. Done. This was comparatively very easy. Now, so we have two methods. We have seen the traditional, it is called old methods, and the modern, these are known as new methods. Now, the what is payback period? Payback period, we have seen that payback period is the time it takes for an investment to generate cash flow sufficient to recover its initial cost. The amount which you have invested, After how much time you will be getting back the investment, the invested amount, that is the payback period. You have invested 1 lakh rupees. After how many years will you will be getting back this 1 lakh rupees? That is payback period. So this payback period, this does not considers the time value of money. That is, it disregards the time value of money. This is the disadvantage of payback period. Now, what is the formula of payback period? That is initial investment. The initial investment which you have made, suppose you have made 1 lakh rupees, and all of your cash inflows, the amount which you have got back in every year, that is cash inflows, the amount which you are getting back. That is the formula of payback. Okay, let's do one question. It will be more clear to you all. So this is the cash inflows, means the when money comes back. When money comes back, that is cash inflow. And cash outflow when money goes out. So this is the practical question on payback period. And what is the decision criteria of payback period is what? We have seen the decision criteria is what? It is very important. I'm highlighting it in the box. Lower the better. This is the decision criteria of payback period. Now, the question is given to you on payback period. First of all, write the formula of payback period. What is the formula of payback period? Original cost of the asset or initial investment upon cash inflows. Write the formula initial investment upon cash inflows, not outflows, cash inflows. Suppose project cost rupees 20 lakh rupees. Project value is given how much? 20 lakh. And yield annually a profit of 3 lakh. Means profit before tax is given how much? Profit is given. It is given 3 lakh rupees. After depreciation, means it is given after depreciation at 10%, that is straight line method. It means that every year you have to deduct the same value from your asset. That is what the straight line method means. But before tax, it is given after depreciation, but before tax. It means depreciation is already been what? It is already been deducted. So what you have to do? You simply have to add the depreciation afterwards. We have seen now over here. First it is being deducted, then it is being added. It is given that it has been considered the profit after depreciation. Tax is how much? 50%. So less tax as from the income statement. 50% means 1,50,000. What will be the result? That is 1 lakh. Just a minute. Okay, 1,50,000. Great. So this is what? This is profit after tax. Now, if we want to calculate ARR, we can consider this profit, but we have to calculate which method? We have to calculate the payback method. So simply we have to, if we have to calculate this method, we want our cash flow after tax. How cash flow after tax we will get? Simply if we add the depreciation. That is 10% depreciation. 10% depreciation of 20 lakh rupees, because the costing is given how much? 20 lakh rupees. So it would be 2 lakh. Simply what you are getting? 3,50,000. That is CFAT, or you can say total cash inflow. Put the value, put all the value in this particular formula. Payback period, initial investment is how much? 20 lakhs. 20 lakh rupees. Now, cash inflows is your 3 lakh 50, means every year you are getting back how much money you have invested? 20 lakh rupees, and every year you are getting back 3 lakh 50,000. So if you will calculate this, you will be getting 5.71 years. It means I will get my money 5 years and 0.71 months. No. How to calculate this 0.71 months? 5 years, 5.1 year, how to know that exact how much, after how much months you will be recovering your money. So simply what you have to do is, for calculating in months, what you have to do, simply it is given 5.71. This is one's value, this is tens value. As we have studied in our fundamental of maths, deduct 5, because on tens place 5 value is given, deduct 5, 0.71. Then we know that in between 5 to 6 years I will be recovering my money, but exactly how much months, how much days, I don't. So what I will do, I will take that, I have to calculate the months, simply whatever amount comes, multiply it by 12. 0.71 into 12, you will be getting 8 point, it means 8 months. So we can say that 5 years plus 8 months, or 5 years, 8 months. This is the payback period in 5 year, and after 8 months, I'm getting back my 20 lakh. I hope this question is clear to you. It was very interesting question. Now let's move to the next method, that is ARR method. So what is ARR method? ARR method, what it says that this method basically tells the average rate of return, or it is also known as what? Counting rate of return. The name of this method is average rate of return or accounting rate of return. So we can say, we can call by both of the names. Done. Now, the accounting rate of return, what it is, again a financial metric, or you can say a financial ratio. It is financial metric that measures what? The average annual profit. It helps in measuring what? Average annual profit of an investment relative to its initial cost. Which cost? Initial cost. It is basically divided by the average annual profit and the cost of the investment. Accounting rate of return is also known as average rate of return. It is a financial ratio used in capital budgeting. The ratio do not take into account the concept of time value of money. So this particular account does not take into consideration what? Time value of money. That is why we uh, calculate what? PAT in such cases. And what is the formula? The formula is average PAT upon average investment into 100. This is the formula of accounting rate of return. Am I clear with this formula? Tell me, any doubt, anyone in this particular formula? Okay, now let's do one question. Okay, suppose you have to calculate average rate of return. Initial investment is given how much? 10 lakh rupees. CFAT is given how much? 2 lakh 20,000. Depreciation is given 20,000. Life is given, total life is given 10 years. Scrap value is given 1 lakh. Now, from all this information, we have to calculate ARR, accounting rate of return. We know the formula. What is average PAT upon average investment into 100? First, we have to find what? We have to find average PAT. We know that CFAT is given, and if we have to find the PAT, what we do? We simply deduct depreciation. So if you will deduct depreciation from 2 lakh 20,000, 20,000 from 2 lakh 20,000, you will be getting 2 lakh rupees. This is what? This is simply PAT. So you have got what? You have got your average. Now, average investment means what? Average means what? Opening plus closing divided by 2. So here opening balance is given, initial investment is how much? 10 lakh plus. Closing it is what? Whenever in the question it is written like scrap value, okay, residual value, final value, closing investment. So all these are what? The closing balance. So how much scrap value is given? That is 1 lakh rupees upon 2. Simply 11 lakh divided by 2 is how much? 5.5. So we have got what? We have got our average investment also and the average part also. So this is given in average. So average part is 2 lakh and average investment is how much? 5 lakh 50,000. Simply put the value 2 lakh upon 5 lakh 50,000 into 100. If you will calculate this, what answer you will get? You will get 36.36%. So this is what? This is average rate of return. Done this question. So we have found what? Average rate of return, or you can say accounting rate of return. This is how we will calculate our average rate of return. So if the closing balance given scrap value, residual value, final value, closing investment. So all these are what? All these are your closing balance. And this question, now let's move to the next question, that is net present value. So what is net present value? Again, it is the difference between present value of cash inflows minus present value of cash outflows. This is the difference between the present value of cash inflows and outflows, the net present value. This value considers what? The first is the formula. Second is this value considers the time value of money. Okay. It is again a type of financial metric to calculate which project is good, which project is bad, to come to a particular decision criteria. It reflects what? Value today of future cash, means present value of all the future cash flows. It indicates that. It is again a very important decision tool of investment, and it considers what? NPV accounts for time value of money, that a dollar today is worth more important than a dollar in the future. Because whatever you are earning today, the same value if you will earn after few time, that will be not worthy enough. So 100 rupees, the value of 100 rupees now is greater than the value of 100 rupees after few years. This is what? This is time value of money. And what is the decision criteria? This is what? This is the decision criteria. Yeah. So decision criteria is what? Whenever any project, if the NPV of that project is greater than the zero, then you will accept that project. If NPV of that project is equal to zero, then it is neutral. It depends on an investor either to accept or to reject. When NPV is less than zero, simply reject the project. Suppose you have, let's take an example, project 1, project 2, project 3. You have invested 100 rupees in project 2 and you are getting 100 rupees. You are investing 100 rupees in project 1 and you are getting 105 rupees in return. You are investing 100 rupees in project 3 and you are getting 98 rupees back. Now tell me, which project will you going to choose and which project will you going to reject in this particular case? Tell me, tell me. So yes, definitely you will going to select this project because you are investing the amount and you are getting back more amount. So you will going to accept. This particular project, it depends on you that whether you will going to invest or not, because you are getting the same return if you are investing. And in this particular project, you know that you are investing rupees 100 and you are getting a loss of rupee 2. That is, you are getting back 98 rupees. So NPV, when it is greater than 0, you will going to accept. Okay, if it is greater than 0, we take the decision criteria as 0. If it is equal to 0, means you are investing 100 and you are getting back 100, then it is neutral. You either you can accept it or you can reject it. If NPV is less than 0, either you can, sorry, you have to reject that project, otherwise you will be getting lost. This is the decision criteria of the project of NPV, net present value. Here, okay, chalo, let's do one question. Compute the net present value for a project with net initial investment of 1 lakh rupees. The net cash flow for 1 year is 55,000. For 2 years, for second year is 80,000. For third year is 15,000. Further, company's cost of capital. What is this cost of capital? Can anybody tell me? This cost of capital is what? Discounting factor. Discounting factor means this factor will tell you the present value of all the cash inflows in the future. Present value interest factor. PVIF, present value interest factor, at 10%. That is, cost of capital is what? 10%. Now, for 3 years are given to you. Suppose the value for 3 years discounting is given to you. But if the value is not given to you, how you will going to calculate this? Okay, how you will going to calculate the 10%? That is simply what you have to do. You have to do 1 upon 1 plus R upon N. That is 1 upon 1 plus 10%. That is 1 upon 1.10. Simply 10% is what? 1 upon 1.10. If it is given 20%, what would be that? 1 upon 1.20. 18% will be there, then 1 upon 1.18. So like this, we have to calculate. We have to do equal to, then m plus equal to m plus. So suppose you have given for 3 years discounting. If you will do this 1 upon 1.10, you will get 0.909. In 0.909, after 0.909, just do equal to, you will be getting 0.826, equal to 0.751, equal to, and in the same manner, you will get every year the discounting factor. This is how we calculate discounting. Although it is given in this question, but in your exam, sometimes this will not be there, then how you can calculate this? Okay. So this is given in the book. That is why, or else in the exam, you will be given only the discounting factor. So this is how we calculate the discounting. Now, how we calculate the present value? Okay, NPV. That is, write all the years over here. Then write net cash flow. Then what? Write what is PV factor? PV at the rate 10%. After this, what you have to write? The after this, the discounted cash flow, what you get, you have to write that. Now, so we have 0 year. In the 0 year, you have invested how much? 1 lakh rupees. So you have invested, the cash outflow is there, write in negative. Then for third year, till third year, I have given the value. That is, in first year, I'm getting how much money back? 55,000. Then second year, 80,000. Third year, 15,000. Present value at 10%. That is discounting. What is the value given of discounting? 0. This would be what? This would be 1, because no value is given. So it would be nothing. For first year, it is given 0.909. For second year, 0.826. For third year, 0.751. Clear? No. If you will do cross multiplication, it will come like this only. 1 lakh 55,000 into 0.909. How much is the value? What is will be the value? That is 4,995. Do multiply 80,000 into 0.826. So what will be the value? That is 66,080. 15,000 into 0.751. Okay. What would be the value? Tell me. Quickly tell me what would be the value. I'm waiting. It would be 11,265. Now, now consider all these things. Add these three items and deduct from 1 lakh. So what value you will get? After this, what value you will get? In actual, you will be getting 27.7, sorry, 340. Let me do the cross. Let me do it. 1 lakh 4,995 plus 66,080 plus 11,265. Then deduct 1 lakh. That is the actual NPV, the discounting after discounting. What value I get NPV? That is 27 lakh 340. Am I clear with this question? Tell me. So you have invested 1 lakh rupees in first year, you have got 55, second year 80, third year 15,000. So actual value which is left for you after discounting, that is 27,340. So this is what? This is the actual net present value. Then if you have any doubt, then ask me. If you will add these all three, then what answer you will get? If you will add all these things, you will be getting 127,340. Deduct the invested amount, 1 lakh. How much you will get? 2740. This is present NPV. Here, any doubt to anyone in this question? Now next. Next is profitability index. Profitability index, it basically tells the relation between the cost and the benefit of the product. How much you have invested and in return how much you are getting, that tells the relation between these two under profitability index. This is an index that either experience or represents what the relationship between the cost and benefit of the project. It is also called value investment ratio, very important, or profit investment ratio. We provide ranks to the project in accordance with their profitability. So profitability index, the formula is present value of future cash inflows by initial investment. This is what? This is the formula of profitability index. Clear? Everybody tell me the formula of this profitability index. Okay. So I'm giving you one question. Solve the question this, or you can also say profitability index of cash inflow upon profitability index of cash outflow. Now, if profitability index is greater than 1, then accept the project. If it is less than 1, reject the project. If it is equal to 1, you are indifferent, means you are neutral. Either you will accept it or you will reject it. Suppose we have three projects A, B, and C. One is giving 1.1, another one is getting 0.8, another one is getting 1.4. So which project you will going to accept? You will going to accept 1.4. And on the basis of such factors, you can also give them the rank. What rank? Suppose you are getting in these two project A and C more than one. So first of all, which project you will choose? First rank you will give to project C 1.4. Then at second you will keep your project A, that is 1.1. So you can give the rank according to it. Now, this is the question. Take the screenshot of the question and comment your answers below. The profitability index of all these three projects. Profitability index 1, 2, and 3. So we have three projects, this one, this one. And the inflows are given for project 1, 6,50,000, project 2, 95,000, and project 3, 1 crore 30,000. Simply you have to put the factor inflow upon outflow, inflow upon outflow, inflow upon outflow. What is the inflow in the first one? 6,50,000 upon 5,50,000. In the same manner, the second one is 95,000 inflow is given and outflow is given 75,000. So we have three projects. Discounted cash outflow is given for every project and inflow is given for every project. Similarly, in project 3, 1 crore 30,000 upon 1 crore 20,000. Calculate and please comment me your answers and also tell me that which project will you going to choose and give the rank accordingly. How you will rank your projects. Okay, I will wait for your answers in the comment section box. So please tell me your answers over there. I hope you have enjoyed today's session. We have completed few methods also of our capital budgeting and we have done its practical problems. The most important questions, they definitely come from all these units, from all these topics. Let's meet tomorrow with another session and please confirm me the answers. Write down in the comment section box which project, for project, like this is project 1, this is project 2, this is project 3. Comment down your answers below and also tell me that how you would going to give them rank. Which project you will going to choose first, which project you will going to choose later on. Well, then we'll meet you tomorrow. Okay. So till then, take care, everyone. Goodbye. And if you feel that these sessions are helpful to you, then kindly like the sessions and share it with others as well. Okay. Bye then. Take care, everyone.